We're going to be a bit contrarian on this panel because we're going to talk about endurance and resiliency in building companies for the long term. We always say at Vintage that it's very difficult to build a big company that lasts for a long time. So I want to invite on stage Nancy Wang. Is she here? Yeah. Nancy, CTO, acting CTO of 1Password, early employee at Rubrik, and ex-AWS colleague as well. And Richard Peretz. Do we have Richard? Oh, yep. And Manny, please go up. We'll make proper introductions. Right. So let me start by introducing each and every one of you. We have Manny from Akamai. You've been leading the security group at Akamai, which today represents 50% plus, much more on the growth, than the traditional business. So we'll talk about that. We have Richard Peretz, who served as the CFO of UPS for more than 3 decades.
The whole career.
The whole career in UPS, more than 3 decades. The last role as a sitting CFO, and took the company public. So I think when you joined, $7 billion. When you left, $75 billion top line, give or take. And Nancy, that I don't know how you do it, but you've done a ton in very short period of time. Early employee of Rubrik, AWS GM. You saw AWS at 20 billion, left 3 years later, 70 plus run rate, today's 120. So we're going to talk about that, how to build resilient businesses that can last over cycles. We're talking about what is the company that the fastest growth to $100 million ARR. Why don't we talk about building enduring companies? So I want to open up with what are those key principles or cultures that you've built and you've seen over the years that will make a company last over cycles? Because now we're in a boom, there will be bust. So maybe, Manny, you want to start?
So maybe let me just start off by talking a little bit about Akamai's history. So we've been around since 1998. Akamai was founded by a professor and student out of MIT. Student was Danny Lewin, who was an Israeli American. Unfortunately, Danny was on a plane on September 11th, so Danny passed away, and he didn't have the opportunity to see what he created. So there is an example of resilience right there as a company. We went public in 98, I think, 99. Our stock went to 200 plus US dollars, and then in a year we were pennies, about to be delisted from the NASDAQ. So, I think from where I stand, I've been in the company for about 20 years, and I've seen a lot of the ups and downs. And I'd say resilience is all about endurance and the ability to go through ups and downs in your company. That's going to happen. Grit is part of life. And I'd say what really, I think, kept us strong was the fact that we were very confident in what we were doing. We wanted to make the world a better place. And we also, I'd say it was in our DNA that, we kept our customers really close to us. And I'd say that is going to be key for us. For anybody who thinks about endurance, keeping your customers close to you is going to be really important.
Richard, any lessons from a transformational journey you talk to me through?
So first, we were 92 years old when we went public. And when we went public, it was really strategically because we had to change the company. And we're talking about enduring companies, but at that point, we were barely outside the US, and we had to start thinking about how to operate internationally and how to add a portfolio of additional services. On top of that, I've also spent the last 5 years in venture and seed and see how they are starting out and looking at customers and determining, are you customer-centric or product-centric? Because that's going to drive a lot of how long you'll last and how flexible you are at meeting your customer needs as you grow and scale.
And Nancy, I think 1Password reported recently you crossed the $400 million ARR. So clearly from here, you're only going up.
That's right. Although I have to say, what actually got more attention than the 400 million AR was the notice that Ryan Reynolds is an investor. So, I guess priorities for different people. Yeah, I would say, look, one thing that I've seen companies that end up going IPO or have amazing exits do really well is actually the willingness to disrupt themselves. And so I'll use an example. Back in kind of the Rubrik early days, and I joined right after Series B. And even back then, our CEO, Bipul, said, hey, we're going to IPO, right? And this was, if you can kind of picture us back then, small office, Palo Alto. We had like one coffee machine. And yes, Arvind Jain now at Glean, he's still very frugal, right? So he's like one pod each, right? And so if you can imagine kind of that extrapolated to the amazing IPO and henceforth performance from the company since 2024, it's really from that willingness to go try new things. And this is often the innovator's dilemma that you face, which is, well, your core business is growing so well, right? You spoke about the 400 million ARR, and yes, today, at 1Password, we have an amazing core business. However, right, as we think about, agent security, agent identity, right, the fact that humans are going to soon have digital coworkers, right, digital colleagues, right? It's really now you're taking resources from your existing business to go fund potentially a startup, right? And so you have to be comfortable with disrupting yourself. And that's, I would say, a common thread that I see amongst founders, CEOs, companies that end up continuing to grow past their initial wave.
And I want to touch on that inflection point of those trade-offs that you had to make. So I don't know if when Akamai decided to go from the CDN business to security, was it an obvious choice? And what was the decision making there? What were the trade-offs? And how did Israel actually had influenced the future of that part of the business?
Purely by accident. The way I'd say what happened to us was in the summer of 2001, essentially there was a botnet called Code Red that was kind of going around the world. Everybody here looks to be young. I remember those days. And that was going to be, we had heard from the White House, or the White House had heard that it was going to be launching an attack on the White House. So we had, at that time, Richard Clark, who was the, I think, Deputy Director of Defense. He came over to our office and he said, I know you don't have a security product, but you have a platform. Can you protect the White House? And so that was our work. We did not have a security product. Actually, we did not have a presence in Israel as well at that time. That was Danny Lewin, even though he was Israeli, it was all in the US at that time. But we put in controls to protect the White House. And then there was this aha moment. If you can do that, why don't we use our platform to build a security business? And therefore, therein came our first cloud-based WAF, web application firewall. So today, just for context, Akamai is over $4 billion in revenue. Security is about 2.2, so more than 50%, one of the faster growing businesses. But it kind of came out of that accidental moment for us.
And I'll take that to Nancy. We'll go back to UPS. But as you think about build versus buy as an acting CTO, you talked a lot about, in your world is around MCPs and agents, and how much are you thinking how those new products will cannibalize or jeopardize your existing business? How much can you isolate from that? How much are you going to buy versus build? How are you guys thinking at a management?
Did you peek on my calendar? Because I literally have a conversation with our chief business officer. He's actually the person who sold SAP or Concur to SAP, and then also Qualtrics to SAP. So that's actually our conversation in about 2 hours. And so
we can have it here. Chathamon rules.
Exactly.
Nobody.
We can run through y'all my mental framework. But look, so from a builder perspective, how we typically think about build versus buy is what is your core competency, right? And also timing, right? Especially in a world where, we think about everything that's happening in AI, right? We call it really the latent space. It's really hard to predict certain trends because, for example, yes, at AWS reInvent, right? Many of you probably were there last week as well. I asked the AGI Labs team, how many agents are actually being sort of deployed in production? Are those programmatic agents? Are those browser agents? How are you actually securing those agents? And I would say, aside from probably the Fortune 50 or maybe the most tech-forward companies like Vercel and others, right? It's actually, we're still kind of dipping our toes in the water. And so many things can change with that agentic development stack, right? We're seeing, tons of growth in, for example, agent builder platforms like Lovable, right? There's a French company that I'd recently just looked at, which is also very interesting, called Dust.tt that, CISOs of Datadog have recommended, right? Regardless of what platform it is, right? How they're, for example, enabling building under the hood is also very different. And so then when you're looking to be the picks and shovels provider of this movement, how do you predict like the different trends, right? What's actually going to be real? Is MCP still going to be the predominant protocol, or is it A to A, right? I actually think that we're going to see a lot more A to A protocols actually being implemented because you are going to see multi-agents now doing entire workflows. So then, again, going back to build versus buy, well, if it's not within your wheelhouse, right? So for example, for us, we're not the creators of MCP. So to go out and build our own, for example, MCP gateway, right? Understanding the high availability nature of having to build a gateway, which I'm sure you're very familiar with, right? That's probably not an endeavor that we'll take on. Instead, we might look to partner, OEM, or even do a little tuck-in, right, to further that.
Let's talk about culture, right? We shared some tenure together, Nancy, and Amazon. That one thing that I think one of the many things that Jeff Bezos did great was build those leadership principles. Being day one always is day one, right? Like that philosophy, that culture clearly drives the company today. What are those leadership principles, culture values that whether Akamai, UPS, and why it's so important over time, right?
Before I get started, this might be my easiest sales call. Maybe I can sell you some infrastructure for MCP servers. That said, I'd say you're absolutely right. Culture is such an integral part of an organization's ability to live long. If you have the wrong culture, then you're going to die, you're going to perish very quickly, and you're good people who leave way before that. The way I think of culture, at least from an Akamai standpoint, is Akamai's origins were in academia. We came from MIT. So if you work with anybody from MIT, my boss is the co-founder. I do not argue with him when it comes to mathematics. That is my first principle. Akamai does everything first principles. My principle is to never argue with him when it comes to mathematics. But first principle thinking is, I think, really important. Thinking foundationally as to how to solve a problem, I think, is rooted in our DNA. And I think that creates the kind of products that our customers like. I also think transparency, coming from academia, again, people like open dialogue, open discussions. I think that really values everybody's input. And I felt, employees have come to me and said, we felt we were heard. Maybe our ideas were not the ones that were chosen, but we felt we were heard. And I think that's a very important thing. There's also a lot of disadvantages along with that because it might take time to make a decision and things like that. But I think creating that employee patronage is so important for us.
So to me, the culture also at UPS, promotion from within was a really important piece of the culture. So someone can start while they're going to college, like I did, and end up in the C-suite. And so what that did is create a management team of 35,000 people who were dedicated to the success of the company, and they get a piece of the company. We were one of the first companies in the late 60s that gave a piece of the equity to every management person at UPS. Now, when I look today at the startups I work with, when I think about the culture has to do with how the founders think about the entire business as they grow the ARR or as they grow their customers. Many times, if there's doing solutions for a specific large Fortune 50 customer, it eats their culture. And what happens is they start to think about their 5th and 6th customer. They can't create the culture that the customers or the companies that think about it from a more holistic product for multiple customers.
Would love to talk about playing defense or playing offense and the capital markets and how to leverage capital markets, capital structure. Like, road to IPO, it's very different than, Akamai's positions and acquisitions. Like, how, now venture capital is quite, at some point in the cycle, it's pretty cheap at some point, capital. Some later in the game it's more expensive. How to think about how to leverage which players in the capital markets to go offense and buy companies, play more defense and do a more balance sheet type of protection. Like, how to think about that. And I know Richard had a lot to say about that, but I would love to hear everyone's.
So first of all, don't go public until you've got everything worked out. Because you go out at 50 or 60, you're at 7, and all you're doing is trying to explain every quarter why you're at 7. So I will tell you, even the hardest thing for a public company is to transform. My stock since I left has gone from 214, it's sitting at 97 today. I'm glad I've been gone 5 years. That being said, the access to capital and the cost of capital through different cycles becomes much cheaper. So for example, we had no debt when we went public. Today, they have about $22 billion in debt because the cost of debt, when I was CFO, the cost of debt for 5 years was just over 2%. So I was using debt to actually pay pensions, because we still give pensions at UPS, because it was cheaper than the PBGC premiums that the government charged. So there's a lot more trade-offs that you're able to do, but in the public markets, you're a lot more exposed to anything you're trying to change.
And Nancy, you also invest on behalf of Felicis, right? And you place really big bets in companies. Like, how do you think about that as a weapon for startups to go win big and really having the capital to play offense?
Yeah, so for example, I think on the JP Morgan slide earlier, I saw the Mercor logo, which is one of the, I would say, companies that we're super proud of in the Felicis portfolio. And that was a deal that I also had the privilege of working on late last year. And I remember, it was a great time. We took out all the founders. Speaking of young, they're all, Peter Thiel fellows, dropouts. So we took them to Ferrari's racing in Vegas, and that is how we signed the deal. But back then, I remember, when we did the deal at 2 billion post, now they're at 10 billion. There's, I think, a Wall Street Journal article about this, right? A lot of other firms who looked at the deal passed because they said, hey, this is really highly priced for where the ARR was. But back then we saw, hey, in the world of RL models, right, in the world where you need to have expert labeled data to go train these frontier models, right, this is on the up and up. And obviously, there are things that we also couldn't have foreseen, which is, Meta taking Scale AI, and now that space is now dominated by Mercor, right? And so I would say if you're thinking about, different, I would say, verticals, different industries, obviously the AI infra space is very capital intensive. And speaking of that, there's another company that we also backed earlier this year called Chalk.ai, which does real-time, data inferencing, right now servicing about, I want to say, a fifth or a fourth of the all credit card transactions in the US, right? And what they're doing is very hard, complex, low-level systems work. And so it really depends on kind of what industry vertical this company is in and how capital intensive it's going to be.
All right, so we're at time. Let's do a last quick by the answer. What would be that one piece of insight? We have mainly VCs, investors here, but like, what to tell to the founders, the underlying company, and how to build an endurance business?
All right, I think I'm going to start. I'll just say that I think you really will have to look at what value you're adding to your customers and how you're creating value in the market. If that's not there, then this is not going to be sustainable.
I would say that you're always going to be changing, because what you're doing today isn't going to work in 5 or 6 years. Your target customer could change, or who it matters to can change.
One phrase, have a chip on your shoulder. That's actually literally what I look for when I make investments, both as an angel as well as a venture partner at Felicis, which is, do you just really have that hunger to prove yourself and to succeed? Because look, especially when you're investing in the pre-seed, seed stage, you could pivot 10 ways a Sunday, right, is what I usually say.
Wonderful. Thanks so much for your time.
Thank you.
Thank you.